In this week's Forex video, I'm going to show you guys how to use Fibonacci to find good profit target areas. Alright, it's always good to have a good location on the chart where you can look to take profits on a consistent basis. Now, before we get started, I would like to ask you guys to like and subscribe this video, as it does give me motivation to continue to make videos each and every week. Alright, now before I get started, let me show you guys my results from this week, and keep in mind I did not trade Thursday and Friday. I basically traded Monday, Tuesday, Wednesday, and here's my profits. I made $817, not bad, not great. Alright, 0 losses, which that's not normal. You know, I'm sure the next trade or two I put on will be losses, but you know, I'm showing you guys that I can apply the methods that I talk about in these videos to produce profits in the Forex market. Alright, now let's go ahead and let's dive into the charts real quick. Alright, so here we are. We're looking at the dollar yen, guys, and you know, if we look up here, guys, we can see we could potentially be forming a hanging man type pattern. Now, those of you that are candlestick gurus will tell me the wick needs to be a little bit longer. I understand that. I don't get all tied up on exactness. Alright, to me, if I look at it with my eye and it looks like it could be, then to me it is. You know, if you try to make things too strict, then you're going to overcomplicate trading. It doesn't need to be that complicated, guys. Now, alright, so this is indication number 1 that we could potentially start to get a reversal. Number 2, we have the MACD indicator. The lines have pinched together. And we also have divergence, right? Now, divergence shows us that, you know, momentum is running out of the market, meaning that the velocity that the market is moving up is not as great as it was over here. Look how straight of a line this was over here. Then we went sideways a little bit and we started to come up again. The market cannot sustain a straight up move, you know, no matter what market you trade. If the more straight it goes up, the more likely it is to come down. Now, this is why we're going to use Fibonacci to try to find good profit targets in the market in case this week we do get a bearish setup in the USD JPY. So we, you know, if that does happen, we need to know where our downside targets could be. So let's go ahead and pull out our Fibonacci tool. In the first area we're going to look at on the chart, guys, we're going to go from swing low up here to swing high. All right, now typically the market likes to retrace to the 61.8 or the 78.6 Fibonacci levels. This is where a majority of the retracements will come in any market. Now, the key area to watch is this 38% retracement. You know, sometimes in a strong bullish move, the market will come down to a 38% retracement and then rally back up again. So this 38% retracement is also going to be key to watch. Now, let's draw one more Fibonacci level, guys, and we're going to go from here to the high, and then we're also going to draw off this swing point here. When in doubt, if you should use this swing point or this one, let's draw them both and see what makes sense. All right, now I'm going to draw this Fibonacci facing this way, just so we don't get everything too confused, because as you start drawing these on your charts, the charts do start to get cluttered up over time. Now, just because we have all these lines on our chart, that doesn't mean the market is going to retrace there, right? But with a high probability, the market does tend to have that much of a retracement. Not because it's Fibonacci, it's just how the market works, guys. All right, now, another element that we want to put into this is market structure. So if we look left right here, guys, we can simply go from swing high down to swing low, or not swing low, swing high to the candle bodies. All right, and we draw that out. Now, when we do that, we want to see what Fibonacci levels we have within that area. When I say Fibonacci levels, again, I'm talking about the 61.8 and the 78.6 Fib level. Well, here you can see the 61.8 matches right up with the bottom one, but you know, I want to try to see if we can incorporate 2 or 3 Fib zones. All right, so here's what we're going to do. We're going to drag this up so that we can match in with this 61.8 level over here. Then we're also going to drag this down to the 78.6 retracement right here. Now we have 1 fib, 2 fib, 3 fib. Now let's go ahead and remove all these fibs so I don't I don't want to get you guys confused as we're looking how to plan this. All right, so if this week we do get a bearish setup, all right, we always want to make sure that we have at least a 1-to-1 risk to reward ratio. Now, for me personally, I will not take a trade unless I can have at least a 2-to-1 reward to risk ratio, which means I will miss trades sometimes. If it doesn't fall within my risk parameters, then I'm not going to take the trade. All right, so let's assume that we get our setup and we're going to just say it comes in around the 116 level. All right, and I don't know that at this point, guys. I need to see a little bit more data on the chart before we can make that decision. But down here to the upper part of our channel is roughly 800 pips. Not bad, right? 800 pips. Now, let's do the same thing to the upside. From there to the swing high up here is about 250. So I'd probably want to round up and maybe put another 50 pips on top of that. So with a 300 pip stop loss, you could potentially have an 800 pip profit target. Now that would be more than a 1-to-1 risk to reward ratio, more than a 2-to-1 risk to reward ratio, and you know it's 100 pips away from being a 3-to-1 reward to risk ratio, which you know the risk to reward does match up. Now keep in mind when we're looking at this, all right, we showed the 38% retracement, and this is where it's going to come into play, guys. All right, we have a 38% from down here. All right, so when we draw that, our 38% retracement is going to come in just above the 111 area. But for those of you that like to alleviate risk, remove risk out of the market as soon as possible, here's what I would personally do in this situation. And this is not trade recommendation, guys. I'm just showing you the tools and the methods that I use when I'm trading the Forex market. All right, I would use this swing here all the way up to the high, and if we make a new high, guys, we'll have to adjust these levels. All right, but with the data that we have right now, this is where the levels will come into play. So once we've come down and tested this 38% retracement, so let's say we got in at 116 and 116 level and the market comes down to here. At that point in time, guys, I would take my stop loss, move it to break even plus maybe 10 pips, and let the market do what the market's going to do at that point in time. All right, there would be no more of myself interfering with the trade. However the market plays out, I'd let it play out. If I get stopped out for plus 10, hey, it's still a winning trade, covers the transactions cost. But if it comes down and hits a profit target, that's a pretty decent win. And some of you guys are going to say, well, if I move my stop loss down, what if the market comes back and hits my stop loss and then comes down to the target? That is one of the disadvantages of moving your stop loss. All right, but one of the advantages of moving your stop loss is you're protecting your capital. All right, every trader is going to be a little bit different. Myself, I want to try to protect my capital as soon as possible, but not too soon. All right, that's part of the methodology that I teach in my trading course that's going to be coming out. All right, you want to be able to remove risk as soon as possible because you got to be honest with yourself. In trading, there is risk, but if you put yourself in a position to win, and by how do you put yourself in a position to win? Good risk to reward ratio, good money management. All right, you don't want to, if you have $1,000 account, you don't want to go out here trading 1, 2, 3, 4 mini lots on a trade and give the market a chance to blow up your account. If you have $1,000 account, you should be trading micro lots, in my opinion, and that's not trading advice, right? But we teach, in the course, what position size you should use to have good money management. All right. Like always, guys, I hope you guys enjoyed the video. Please like, subscribe, and if you're not yet a member of the free daily Forex bias that we're going to be releasing, it looks to be in January, then click on the link below this video, sign up so you don't miss it when we relaunch that in January 2017. And like always, guys, until next time, good luck and good trade.